All right, so inflation is 10% in 2022. The stock market has dropped a terrible 22% for the year. And it seems like the Fed is completely hell-bent on causing a recession within this year or the next, likely so they can cause an increase in unemployment as a way to combat the wage gains that's happened over the last year, while also decreasing and curbing consumer demand. So all that really just means that we have to come up with new strategic ways to better manage our emergency funds so that whatever hits the fan, we're well prepared for. So that means in this video, I'm going to talk about a strategic way to help you build that emergency fund, help you beat inflation, all the while saving a crap ton of money on possible mortgage interest payments over the course of your mortgage. And if you don't have a mortgage, I also have some recommendations for you if you happen to be a renter, or just generally good advice on how to manage your money moving forward. So with that said, let's go ahead and jump right in. So the best way I think to build your emergency fund is something that I call mortgage parking. So typically when you have a mortgage, you pay your mortgage each and every single month. So month A happens and you make your mortgage payment. Month B happens and you make your mortgage payment. Each and every single month, you make one singular mortgage payments. However, with mortgage parking, what you do instead is you make 2 mortgage payments or 3 mortgage payments in one singular month. So month A happens, you instead of making 1 payment, you make 2. Or if you have more capital, more income, you can afford it, then go ahead and make 3 mortgage payments. So you may be thinking, oh my goodness, that is insane. Why do all that? Here's why. Time. By using mortgage parking, you're essentially buying yourself time in the future. You're buying yourself a financial runway should something adverse financially happen to you. So whether you lose your job or a tree hits your car or your house, whatever catastrophic event happens, you at least have a financial runway of time built in to your mortgage payments. And typically your mortgage payments, in addition to transportation and healthcare, happens to be the most expensive aspects of most people's budgets. I know it's a little weird, a little strange, like why do that? I'm about to get right into that. 3 reasons for why I think mortgage parking is a beneficial strategy for building your emergency fund, in addition to also combating high inflation. Reason number 1, the best way to save money is not by forcing yourself to transfer the money from one location, your checking account or whatever it comes into, and then moving it over to your savings account or your brokerage account or what have you. The best way to save is always an automatic process. Something that you don't have to think about at all. So your money comes in and it's before you even know that it's came in, it's automatically transferred over to some type of savings account or brokerage account and invested for you or what have you. But the process is automatic. Well, the benefit with mortgages is that it is an automatic, compulsory situation that you absolutely must do. And because it's automatic and because you have to, therefore, you will always make your mortgage payments, therefore forcing you to save. And not only that, within that same point here, right? Every time you make your mortgage payment, we know that there's different components of that mortgage payment. There's taxes, there's principal buy down, and there's escrow. Well, that principal buy down is building equity within your house. So you're saving a ton of interest and building equity in your home. And because of how mortgage amortization schedules work, the earlier you buy down or make extra payments in the life of your mortgage, the earlier you do that, the more in interest savings you will have over the life of the mortgage loan. So that's point number 1. And within the same point here, putting your money in your house is almost always a great idea because of inflation. Each year when inflation is high, the value of your house goes that much higher. So your house value keeps pace with inflation. So as if that's not enough, here's point number 2. So I've already kind of mentioned it, but I'll clarify further. With mortgage parking, when you make an extra payment within a given month or you make 3 payments within a given month, you are giving yourself a financial runway. And if emergencies happen, So that means you're taking your excess capital or your extra income and making multiple payments, buying you time in the future of 1 month or 2 months or 3 months. However, those payments are not gone, right? So when you have an emergency that happens a month from now or 2 months from now, you can go ahead and recoup that money you already placed in your mortgage by now skipping a mortgage payment. And it's not going to be a negative hit on your credits or look bad in the eyes of the bank because you've already made your payments, you're already ahead. And so by now saying, okay, hey, now I have an actual emergency. Let me not, and because I have reduced income, maybe because you lost your job or something happened, you could say, hey, I'm ahead a couple months, so I can afford to not make my payments for 2-3 months until I can resolve and take care of the financial emergency that's happening right now. That is the financial runway, the benefit you get from mortgage parking. And now number 3, and probably the best parts of mortgage parking, is that once you build a momentum of having 1 to 2 to 3 months runway of time, you will want to keep that momentum. You will be very incentivized to make sure you don't use up that runway for something trivial like maybe buying a flat screen TV or buying an expensive car or whatever else fancy toys that you're really wanting. You will want to keep that security in place. If you're liking this tip, go ahead and subscribe and let me know in the comments below what you're thinking about it so far. Alright, so nothing is perfect, so there's got to be some drawbacks. I can only think of 2 drawbacks right now, so I'm sure you're probably thinking of some and I'm very interested. Let me know in the comments below. And so the first drawback is that, hey, if you have the extra funds or extra capital to make a extra payments on your mortgage, why not instead apply that directly towards your principal? And that is a fair point, because if you do that, you will pay off your mortgage much faster. However, the goal here with this emergency fund idea is that you're trying to build yourself some financial runway. And so making a principal payment does not buy you extra time in terms of not paying your mortgage next month, or giving yourself that amount of room to have that freedom to skip a payment should something adverse happen. And at the same time, when you do mortgage parking, a portion of your mortgage payment will go automatically to interest payments already, therefore reducing the mortgage pay down, however, not as fast as applying the entire sum directly to the principal. So you're still coming out ahead, just not as fast as you might if you put that entire amount to the principal. And at the same time, if you do that, you're not really going to benefit from having an emergency fund via your mortgage. And the second drawback stems from the amount of capital required. So in a situation like this, you'd have to have a lot of savings already, or have enough high income coming in per month to be able to afford yourself the ability to go ahead and make those amount of extra mortgage payments. Or you may be in a situation where your mortgage is so low in terms of the payment. Let's say your mortgage payment is a fantastic $800 a month, including mortgage, including taxes and escrow and all that. If that's the case, then you may likely be able to slap as much possible to buy yourself that much freedom, and good on you for that. But in general, this does require a lot of capital and or a high income to be able to do something like that. But if you happen to be a 2-income household, this may be a great idea in general, because both of you can combine to be able to get yourselves that financial runway so you can better mitigate a downturn or some type of economic crisis that happens. I think mortgage parking is a great idea because right now the highest savings yield on a savings account is going to be 2.15%. And of course, inflation is at a horrible 9 to 10%. And so you're losing 8% of the top. On top of that, we've already mentioned that the stock market is down 22% and may continue to go down even further next year or the year after that. So there's no real safe way to put your money. And so why not put that money in your house, but give yourself financial runway so that if something adverse happens, you'll be able to recoup that by not making a payment and use that money then to do something else. If you don't have a mortgage, my best recommendation for you is to automate your savings. And this generally applies to everybody, really. Automate your savings so that you remove yourself from the funnel of saving your money. Because if you don't automate it, what tends to happen is you'll find an excuse to spend that money somehow, or something will invariably happen where you'll, part ways with that cash. So automate your savings, automate your savings. If you enjoyed this video or you think that mortgage parking is a great idea, make sure to share this with at least one friend and family. And make sure to subscribe as well. With that said, thank you so much for watching. Till next time.